Iggy here. A massive welcome to our new members. We are now over 5,600 subscribers strong with a paid inner circle of 140 plus members. A quick reminder, I believe the 6 for the heavy analytics, but the YouTube bundle covers both. Choose what fits your style. But today, let's dive into the numbers. Now, to understand the chaos unfolding in Jakarta right now, we need to go back to school and talk about a concept that controls trillions of dollars, but that many retail investors may overlook. That concept is the index gatekeeper and the specific rule of free float. You see, a significant portion of global capital isn't managed by active humans anymore. It is managed by passive algorithms that track an index, like the S&P 500 or the MSCI Emerging Markets Index. These algorithms are essentially automated. They don't look at balance sheets. They don't analyze the news. They follow the list given to them by the gatekeeper, which in this case is MSCI. If MSCI says a company is in the index, the algorithm buys it. If MSCI kicks it out, the algorithm sells it. Now, before we go further, let's pause on the term free float, because this is a critical detail. In simple terms, free float refers to the portion of a company's shares that are in the hands of public investors and available for trading. It excludes the shares locked up by insiders, promoters, governments, or founding families. Why does this matter? Imagine a company has 1 million shares. If the CEO owns 990,000 of them and refuses to sell, there are only 10,000 shares left for the public. If a big pension fund tries to buy 5,000 shares, the price could skyrocket artificially because the supply is so tight. This creates a cornered market. To prevent this distortion, index gatekeepers like MSCI have a rule: they only count the free float. If a major shareholder owns 90% of a company but obscures that ownership to make the stock look liquid, that is a direct violation. It distorts the price and impacts the algorithms. When the gatekeeper identifies this, they don't just issue a fine. They can halt index adjustments. That is exactly what has happened in Indonesia, leading to the liquidity concerns we are seeing now. So let's look at the headline. Governance concerns have escalated in Jakarta. On January 28, 2026, MSCI Inc., effectively the referee of this global sector, officially froze all index adjustments for Indonesian equities. They cited fundamental investability issues. In plain English, they flagged opaque shareholding structures and coordinated price distortion. Essentially, the concern is that too many Indonesian stocks are controlled by concentrated interests with very little actual stock available for public trading, potentially keeping prices artificially stable until now. The fallout was immediate. The Jakarta Composite Index, JCI, plummeted 7.4% in a single day, triggering a 30-minute circuit breaker halt. Now, let's define circuit breaker for those new to this. A circuit breaker is an automatic mechanism at the stock exchange level. When the index drops too fast, say 5% or 7% in a few hours, trading is paused. It is designed to mitigate panic selling and give investors time to assess information. However, historically, this can sometimes increase anxiety in the market, signaling a liquidity trap. When a market faces investability concerns from MSCI, passive funds like ETFs and pension funds may be forced to pause buying. Now, you might be sitting in Bedok or Tampines thinking, Iggy, I don't own Indonesian stocks. This is an Indo problem. But financial contagion often impacts the broader region. This brings us to the implication for local investors. What could a freeze in Jakarta mean for CPF savings? Many Singaporeans hold ASEAN Growth funds or Emerging Market Opportunities funds in their CPF-OA or SRS accounts. If you look at the fact sheet of these funds, they often have significant weightings in Indonesian banks like BCA, BRI, or Mandiri, as these have been key regional growth drivers. Here is the risk factor. If MSCI downgrades Indonesia, those funds could experience a net asset value, NAV, adjustment. The NAV is essentially the price tag of your unit trust. It is calculated by taking the total market value of the fund's holdings, subtracting liabilities, and dividing it by the number of units. If the underlying assets, the Indonesian banks, drop due to capital flight, the value of the fund holding those assets drops. Investors continue paying management fees, but the fund faces headwinds due to asset devaluation. This is why some investors might see their portfolio balance stagnate, driven by regional volatility rather than local economic issues. Now, I included a table in the newsletter from Goldman Sachs, and I want to highlight a significant projection. Goldman estimates that an adjustment in free float calculations could trigger US $2.3 billion, nearly 3 billion Singapore dollars in outflows. When that amount of capital leaves a market that is already facing liquidity issues, prices can gap down. Gapping down means the price closes at $10 and opens the next morning at $8, skipping the levels in between. In a gap down scenario, stop loss orders may not execute at the desired price, leaving positions vulnerable. So what happens next? There are three potential scenarios. First, the bull case. Optimists may view this as a temporary administrative issue. They believe the Indonesian regulators will resolve the data discrepancies by May 2026, MSCI will lift the freeze, and capital will return. In this view, the current drop could be seen as an opportunity for those with high risk tolerance. Second, the bear case. This is the frontier downgrade. If the issues are not resolved by May, MSCI could downgrade Indonesia from emerging market to frontier market status. Frontier markets like Vietnam or Nigeria are generally considered less liquid and more volatile than emerging markets. If Indonesia is reclassified, billions of dollars in passive funds mandated to hold only emerging market stocks would be forced to sell. Third, the base case. The freeze continues and the market drifts. Liquidity tightens, creating a scenario where prices may not crash further but struggle to recover due to a lack of fresh inflows. Now, proponents of the Indonesian market will argue that the country has massive natural resources, a young population, and strong GDP growth. Fundamentally, the economic story remains strong. Indonesia is a powerhouse of commodities and consumption. But here is a key lesson. The stock market is not the economy. Strong GDP growth does not automatically translate to shareholder returns if governance issues persist. For my own strategy, I am looking at the safe haven dynamic. When global investors are concerned about Southeast Asian volatility, they often look to Singapore as a defensive position. I expect the Sing dollar to remain resilient against regional currencies. The rupiah has already weakened to nearly 17,000 IDR per USD. While this makes travel cheaper, it poses challenges for export businesses. Compliance reminder. If you are considering looking for value in Jakarta or buying stocks like C Limited, remember that foreign-listed stocks cannot be purchased directly using SRS or CPF funds. This is a cash-only trade. Also, for those looking at SDRs or smaller caps, please check with your specific broker as SRS funding availability varies. I always stress test my portfolio against inflation. While official Singapore core inflation is lower, I personally use a conservative 3% hurdle in my models. If a stock yield can't beat this 3% benchmark, plus the risk of currency depreciation, I generally do not consider it suitable for my portfolio. In this case, with the rupiah weakening, the required yield to break even in Singapore dollar terms becomes significantly higher. The bottom line is this: I am careful not to confuse a cheap price with good value. Indonesia is currently facing significant regulatory scrutiny. Until the governance clarity improves, institutional flows may remain paused. In 2026, managing volatility is my priority. While some aggressive investors may try to bottom fish in Jakarta, I am personally focusing on the relative stability of Singapore banks, prioritizing consistent dividends over speculative capital gains. I prefer to let others chase the excitement while I focus on cash flow.